Okay. Assalamu alaikum, dear students. How are you? This is your trainer Mustafa Mirchawala from Mirchawala's Hub of Accountancy, and I've been teaching for last almost 15-16 years, and my primary papers are financial reporting of all levels: basic, advanced, super advanced, and even corporate reporting of ICAEW, and also F6 taxation, right? Okay. And the objective of today's lecture is current issue of SBR, current issue of SBR, right? If you go in past 3 years back, so when there was a P2, when this paper was P2, the current issue portion was 25 marks. There was a 25 marks question used to come for current issue, right? But yes, at that time, you had choice available. So normally, majority of students used to skip this question in choice. But now, as this new SBR paper, it does not contain any choice, so it's a mandatory portion. But yes, the good news is that in past its weightage was 25 marks, but now it's around 8 to 10 marks almost. If you round it off, it's 10 marks or 9 marks like this. Okay, so they have reduced the weightage of current issue. Why? Because the current issue is a research based area. Now I'm going to discuss some basic points first, and then we'll move on to the current issues. First of all, you must know it may come in any question. Normally students think that it will come in question number 3, but go and check the past papers of last 3 years. You will find current issue in question number 1 as well. You will find current issue in question number 1, consolidation question as well. So it may be tested in question number 1. Okay, but normally if you see the pilot paper, when SBR was launched for the first time, in the pilot paper, the current issue was in question number 3. That's why many teachers say that it may come in question number 3, right? Okay, now one more thing, current issue is the specialty of ACCA. If you find other qualification like ICAEW, even in ICAEW, they don't test the current issue, because the current issue is related to those standards which are not already applicable in this world. They are in process. They are in process accounting standard, like they are in the form of exposure draft. They are not real standards. So that's why in other qualification it's not tested, but ACCA prepares you for future, right? The name, I hope you have seen the logo of ACCA, think ahead. The logo of ACCA is think ahead. So they see the future, they prepare you for future, right? Okay, so that's why they have included this in your course, right? Now this is a very common question: from where can I study current issue? From where should I prepare for current issue? Now that's a very big question. Normally the best answer for this is read all UK teachers, Kaplan, BPP teachers, they all recommend to read the technical article. This is the first and primary document, technical articles at accaglobal.com. You all must read the technical articles. Normally current issue comes from those technical articles. That's the past. Okay, but one more thing, you should also see the latest exposure draft, and that will be available on big four website. Latest exposure draft you can get from big four website, but it's a big procedure, and it needs a lot of time. That's why some teachers, they don't recommend to go to those websites, because you will be lost. That they are very detailed, and you don't have time. And I must say this is against smartness as well. Okay, so the best thing is you read the articles. Yes, that's for sure, it's mandatory, technical articles of ACCA, and then you can attend a lecture with summarized lecture, like just like this today's lecture. So you will have an idea, right? Now one more thing, see, I have openly written that is, there is no guarantee of current issue. It happens many times. It's a luck. Current issue is a luck. It happens many times. We teach 10, 8, 7 current issues, and not a single current issue came from the class. It happens. Okay, so yes, but whatever efforts we are going to put in today, that it will benefit us. It will benefit us in real life, or it will benefit us in understanding new things, but there is no guarantee. So that's a pure disclaimer. Don't think that you will get the same current issue what we are doing today. So don't over expect, right? That's very simple. I've already told you about the latest articles and exposure draft, but exposure draft, if you go to websites of big four and you study exposure draft, it takes a lot of time. It takes a lot of time. So if you have time, go do that. I don't really recommend. I don't really recommend it. Okay. Now once again the question, why ACC has included the current issue. Actually, if you see the current world, there is one thing which is constant in the society is change. Lot of change in the society, lot of a daily, the change is a routine thing. The change is a routine thing. And this change is in IFRS as well. We have seen replacement of many old standard with new standard, like IFRS 16, like IFRS 13, like IFRS 15, right? Revenue standard change. So the change is constant. The change is constant, and that's why this change should be, the reasons for this change must be known to the student. The reason of this change must be known to the student. That's why they have included it. Now, when the change when the change is small, let me teach you something, and that this will benefit you in normal SBR paper as well. For example, you are an accountant. Look at here. For example, you are an accountant and you find a new transaction. You find a new transaction first time in your company. This never happened before in your company. A new transaction, a very new transaction you found. So now how will you treat? How will you treat? The first step, see this, it's all written in IS 8. The first step, you will open the IFRS book. You will open the IFRS book. If the treatment of that transaction, if the treatment of that transaction is written in IFRS book, just follow it. Just follow it, because IFRS is applied in your company. Okay, so if the treatment of that transaction in the IFRS book, in the main IFRS, just apply it. That's the best solution. Second, but what if that transaction is not included in IFRS book? Because yes, IFRS I means international. So it's for the whole world, and International Accounting Standard Board cannot cover International Accounting Standard Board cannot cover each and every transaction of the world. So that's the limitation of IFRS. Yes, it's a practical limitation. So now what you do, if the treatment of your transaction is not present in IFRS book, then you see the similar transaction. You try to find the similar transaction, and you do the similar transaction treatment. You copy the treatment of similar transaction. Okay. And if there is no, if there is no similar transaction, if there is no similar not present in the IFRS book, no similar transaction, then the last thing is conceptual framework. Solve that transaction, solve it using conceptual framework guidance. So this is the order we follow when we find a new transaction. Okay, don't forget, this is not current issue. This is part of your normal course. This is just not current issue. This is part of your normal course. This is part of your normal course, right? Okay. Now, one more thing which may come in your current issue part, and I have seen many students, even many position holders, they follow this instruction. Criticism on different standards. Criticism on different standards may come in current issue. You can read from your study text. It's present in your study text that criticism, in all standards there are some weaknesses. In all accounting standard there are some weaknesses, and examiner may ask the weakness from you anytime. So it's better you are prepared. It's better you are prepared for these criticisms. It's better you are prepared for these criticisms, right? Okay. And they are available in a study text. You can have a look. Okay, to be on the safe side. Now, thing which I'm going to teach you now is the real part of the class. I know I'll teach all many current issues and a lot of things, but this is the heart of the class now, I'm telling you. And this is my overall experience, I'm telling you. And this is the summary of all major UK teachers, I'm telling you. And this is the good news for you, good news. And even, you know, I sometimes tell my students that it is easy to clear SBR as compared to F7. It is easy to clear SBR as compared to F7. It's a for sure thing. Even you can see the passing rate. The passing rate of SBR is all 99% time it's better than F7. 99% time the passing rate of SBR is better than F7 because it's a theory paper. So you write many things in your own words and you get marks. Sir, how we get marks? Now look at here. If you read the examiner report and if you see the marking guide, there is one thing which is present in your professional exam is headroom issue. Headroom issue. What is headroom issue? Just think. You have a question paper and it is written that requirement A is of 10 marks. You have a question paper and there is one requirement in that question paper, requirement A, and it is written it is of 10 marks. Okay. So this 10 marks means, listen, this 10 marks means maximum marks you can get is 10 marks. Maximum marks you can get from this question is 10 marks. But now when the marker, the one who checks the paper, when the marker starts checking this question, this part, he will check it as if 14 marks are available. As if 14 marks are available. The maximum marks written in front of you, in front of the student, was 10 marks. But when the marker starts checking this part, 14 marks will be given to him. So now what if you do 4 marks mistake? If you do 4 marks mistake in this question, so 14 minus 4, still you will get 10 marks. Still you will get 10 marks, which is your complete marks. That means ACCA has given you a room to do mistake. In these professional exams, ACCA has given you a room to do mistake. Even if you do slight mistake, still you will get the full marks. And if you do many mistakes, still you can take 5 marks out of 10. And 5 marks is enough. Your passing marks is 50 and your objective is to clear because it's a big paper. The big paper, your first target is you have to cross the 50 marks border. So this is a very, very good news. My dear student, this is a very good news that even if you do mistake, you will still get full marks, or you will still get a 7 marks out of 10 or 5 marks out of 10. And yes, you have to take 5 marks. 50% is the passing marks. So in the examination, listen my words. If you find the paper difficult, and it's naturally difficult because this is a research-based paper, real life scenarios come and new things come in this exam. You know this. So don't worry. Don't start crying. Yes, it applies on all questions. Don't worry. Don't start crying. Don't create panic. Otherwise, this panic will disturb your whole paper. Just think about this issue that after doing mistake, still you will get pass. And that's why I often say my students to attempt 100 marks, attempt full paper, because in each and every question, this thing is applied. In all 4 questions, this scenario is applied. But if you miss a question, you will miss complete 25 marks. If you miss a question, you will miss complete 25 marks. So at least do something in your own words. Believe me, I've seen many ordinary students, they clear the paper. When they give the paper, they say, oh, our paper was not well. But on the result day, they clear it. This is the game. This is the real game. That's why, now listen my words. I'm going to say one more golden words. That's why it is written on the ACCAglobal.com website. ACCAglobal.com website that for SBR paper, let me highlight. For SBR paper, breadth is more important than depth. Breadth is more important than depth. What does it mean? It means do many things. Do summaries of all topics rather than doing 3 topics in detail. Rather than doing 3 topics in extreme detail, better do 10 topics summaries. At least you know little of everything, so that you can write something and you get some marks. If you do something, if still you will get the marks. This is written by your examiner. I'm telling you, go and read on the accglobal.com website. This is clearly written. Breadth is more important than depth. And see, I personally experienced this in last 15 years of teaching. I've seen many past papers. Even even myself, I sometimes teach things in very detail. Our courses are 100 hours, 120 hours. But when students open the past paper, only little issues come. Believe me. So it's better to do many things. Summarize in a summarized way, than to do few things in depth. Don't forget these things, okay? So still you have some time. Still you have some time, my dear student. Better go for summaries. Better go for summaries, okay? Right? And you don't need things in detail. You don't need things in detail. Any issue with the audio? Hello? Is still any problem? Or it's fine? It's okay. Okay, it's okay now. Okay, I got it. There was some little internet issue. It's okay now. Okay, now let's do the first current issue. That is the disclosure problem. This is the disclosure problem, and few of UK teachers also recommending this for last 3 attempts. Few of UK teachers also recommending this for last 3 attempts, but it has not come, to be very frank. But still we'll do it and we'll get an idea. But now what the last slides I taught you, go for summaries. Don't go anything in depth. You don't need, this is not the requirement of your examiner, okay? Because of the headroom issue. Now, what is the disclosure problem? We know hello. Okay, sorry. It was a slight internet problem. I hope everything will be perfect now. Now listen. So this is the first current issue. Now try to understand the concept. Try to understand the concept of each and everything. We all know that now the accounting there are many international financial reporting standard, lot of developments. Every year new standards are coming, and in detail standards are coming, and there are a lot of disclosure requirements as well. But the problem is that if you see the financial statement, it's of 100 pages, 200 pages. It's a big burden on shareholders now. And shareholders don't have that much time to see each and every disclosure. So there is a heavy disclosure requirement in the financial statement. So now the International Accounting Standard Board is working on this project. This is also called better communication project, or it is called disclosure problem. That they need to cut down the irrelevant extra things in the financial statement, because the financial statement looks too overburdened. And shareholder does not have time to see each and everything. In past I made a video on this, the OCI thing, that many of the shareholders, it is the research, that many of the shareholders, they only see the profit and loss page. There is a big quantity of shareholders, they only see the profit and loss page, nothing else. So International Accounting Standard Board is thinking to reduce the disclosure requirement, to reduce or to make the disclosure requirement perfect, to make the disclosure requirement perfect. Okay, so now see what is not enough relevant information. The financial statement nowadays is full of irrelevant data, too much irrelevant information, ineffective communication of the information provided, and even the communication is not effective. Now you may ask, sir, why accountants make such detailed disclosures? Because they want to protect themselves as well. Because in past it happened that the financial statement, there were some less disclosures, so there were cases against the accountant. So actually accountant basically protect themselves. Basically they want to protect themselves from legal litigation issues. That's why they do detailed disclosure accounting. But again, that detailed disclosure accounting is not in favor of the shareholders. They are not in favor of shareholders. Why they are not in favor of shareholders? Because shareholders don't have that much time, and there is a duplication of data as well. There is a duplication of data as well in the financial statement, right? So this is the problem. This is the problem, that financial statement, this is the problem. Even if you do reading of articles, if you guys do read the articles, there is an article on the accglobal.com, and the name of that article is bin the clutter. That article is on the same topic. I must say that article is also on the same topic, right? Okay, now what is the solution? See, develop principles of effective communication, develop principles of specific communication. Now the board is trying to give solution of this. Number one, first of all, it is written entity specific. The board is planning to give entity specific guidelines. Like for banks, they want to give certain different guidelines. For manufacturing sector, they want to give different type of instructions, so that it should be effective, right? Currently the guidelines are almost same for everybody, but now in future, because this is the current issue, it has not yet been applied on the world, right? So now they are planning to do entity specific guidelines so that it will be more effective. Then it should be described as simply and direct as possible. They will guide accountant to do direct communication. No need to do detailed things. Just try to be effective. Then organize in a way that highlights important matters. Now I have written here example of OCI. Wait, example of OCI. You know, almost 15 years back, almost 15 years back, income statement was without OCI. OCI used to be on different page. OCI used to be posted on different page. Example on Soshi. OCI used to be included with Soshi, statement of changes in equity. But then Accounting Standard Board realized that majority shareholders read the page. Of income statement. So what they did, they fix the OCI with the income statement. Look at here. They fix the OCI with income statement, so that whoever will come to see the income statement will also see the OCI, right? So the placement is also matters a lot. Way to fix what? Similarly, it is the mandatory requirement. You all know this. You guys have done financial reporting, that you need to report EPS on the income statement page. You need to report basic EPS and diluted EPS on the income statement page. So this is also a good thing, so that shareholders can see the EPS immediately with the income statement, right? That's a very relevant number for shareholders. Then linked when relevant to other information, it should be relevant. No duplicated unnecessarily. Yes, I have written example of IFRS 13. Now if you guys have studied the history of IFRS 13, The name of IFRS 13 is fair value measurement. The name of IFRS 13 is fair value measurement. Now listen to me. There was a time when there was no IFRS 13, back 8 years back, 8, 9 years back, when there was no IFRS 13. So each and every standard, accounting standard, has its own guideline of fair value, So normally one accountant has to study fair value 20 times. For example, there are 20 accounting standards. For example, there are 20 accounting standards in which fair value discussion is there. So accountant has to study 20 times, and they have to make disclosure 20 times separately. But now after the introduction of IFRS 13, we just teach accountant fair value one time. And now he's the expert of fair value. He can apply fair value anywhere. So the duplication of data, the duplication of resources are saved now. So in this direction, standard board is going. Okay. So for future, they will do more things. They will do more of such things that will reduce duplication. My dear students. Okay. Now, provided in a way that optimizes comparability. Yes. Comparability is very important thing. And just to improve this comparability, if you see new accounting standard, normally they are giving with single treatment. In past, there were many accounting standard with optional treatment, like IS 16. In IS 16, you have two models, cost model and revaluation model. And you have a choice, to opt one of them. But if you see the latest accounting standard, they emphasize more towards the fair value. Like, for example, if you think about the financial instrument, and think about the financial assets, come on, all of you think. If you think about financial assets, so in financial asset, almost everything is fair. Equity market is total fair value through P&L, fair value through OCI. In debt market, majority things are fair value except amortized cost. So you just think the 80-90% treatment of financial instrument is now fair value. So why they have emphasized more on fair value to promote comparability, Okay. So this is also the target of the board. So now these are the some solutions which you need to know. First of all, we discuss the problem, and then this is the solution. Now, few more guidelines by the board. They are planning. That's their plan. Not yet implemented, but they are planning. Requiring an earning before interest and income tax, EBIT, operating profit subtotal. Now you will say, sir, we have already seen EBIT or PBIT number in the income statement. But if you have studied F7, in nowadays the latest F7 question, the examiner directly calculates PBT. Or if they calculate PBIT, sometimes they include investment income in PBIT. But in reality, operating profit just should only contain things related to operations. Operating profit should only include earnings related to operations. They must exclude investment and other income, right? So they are going to be more focused on EBIT number, and that will be more and more related to operational earnings, right? Then requiring incomes and expenses for investments category. Yes, nowadays there is no separate breakup. For investment income in the income statement. Look at me. In the cash flow statement, boys and girls, please hear. In the cash flow statement, yes, there is a separate section of investing activities. I agree. In the statement of cash flow, there is a separate head of investing activities in which a shareholder or user can see the investment cash flows. But in the income statement, there is no separate head. In the income statement, there is no separate head. Of investing income and investing expense. So the board is planning the same thing as they have done for the statement of cash flow, that separate analysis for investment income, right? Then providing guidance on presentation of management performance measures. Yes. Wait. Till now, we have studied APM and normal ratios as well. Additional performance measures we have studied, and we have studied normal ratios as well. Till now, there is no IAS or IFRS. Till now, there is no IAS or IFRS for ratios. So normally companies calculate ratios with their own. So what they do, they only present only those ratios which are favorable for them, or they use formulas with their own wish. They use the formulas of their ratios with their own wish. So this thing distorts the comparison. This thing distorts the comparability. So now board is planning. Now board is planning to make some ratios mandatory. To make reporting of some ratios mandatory, like EPS. See, EPS is a mandatory ratio. EPS, earning per share, is the mandatory ratio which must be presented on the face of the SOCI, right? So similarly, they are going to work on few more ratios which should be presented. That's their plan. And the last thing, better ways of communicating other comprehensive income. Better ways of communicating other comprehensive income, and they have tried a lot. They have, I must say, they have, in this area, they have worked a lot. Already they have worked a lot. You know, OCI is always a debatable issue, that what thing will come in OCI, right? And what is the future of OCI? Because some of the OCI are reclassified to PNL in future, and some OCI are not classified in future in PNL. Like, giving you example, foreign exchange gains and losses. Foreign exchange gain on losses of foreign operation or foreign subsidiary, they are recorded in OCI now. In future, when you dispose of that subsidiary, they are transferred into PNL. They are transferred in the PNL, right? Okay, right. But if you see IS 16, revaluation gains and losses, IS 16 revaluation gain, upward revaluation gain, you book in OCI now, but in future you don't transfer, you don't reclassify into PNL. So still there is some confusion in that area, that what thing will go in PNL and in future, and what thing will go in OCI, and what's the logic behind it. Wait, let me connect the screen. One minute. Let me connect the screen. One minute. Wait. Okay, it's perfect now. So they are also planning to improve the OCI as well. Okay, so This was your first current issue, this was your first current issue, and whatever I've said, I've written here as well. Okay, see, this was your first, and this is related to disclosure problem. And if you want to read in more detail, if you want to read in more detail, you can read bin the clutter. Okay, but again, I would recommend now summaries, because I told you the one of the basic exam tip, headroom issue, that you have, they give you extra marks. Now the second, my dear students, the second current issue I have selected is cryptocurrency. Yes, it came in past it came, it already came in past. But sir, why have you selected this? Now the answer is, listen my answer. You know, ACCA is very active body. It looks the environment around you, and the paper is prepared with reference to the environment. If you see the last attempt paper, all of you listen to me, if you see the last attempt paper, look at me, there was a 25 marks question or a major question of intangible asset. There was a major question of intangible asset. Listen, one thing, my WhatsApp number is written here. See, on the screen my WhatsApp number is written. You can copy it. I'll share the slides with you guys. Don't worry. I'll share the slides with you guys, don't worry. My WhatsApp number is written here. Okay, just copy it and now concentrate on the lecture. So if you see your last attempt, attempt past paper question, there was a 25 marks. There was a 25 marks or a complete question of intangible assets. That was the student feedback. Why? Because this year, because of COVID, technological companies went on touch sky high. They went sky high. You see the share price of Apple, you see the Apple, Google, Facebook, and all these technological stocks. All these technological stocks. Wait a minute. Yes, screen sharing, a little screen sharing issue. Wait. So if you see the last attempt, there is a 25 marks question of intangible asset, because of the technological companies got boost in this COVID era. So that's why your examiner may you check the knowledge of intangible asset. Similarly, boys and girls, if you see this year 2020, 2020 is the ideal year for Bitcoin. It's a magic year for Bitcoin. Bitcoin touched almost $20,000 this year, right? So this is the year of cryptocurrency. If you see. So there is a possibility. There is no guarantee. I repeat, there is no guarantee, and nobody can take guarantee. There maybe examiner may test the treatment of cryptocurrency, may check the treatment of cryptocurrency. But you all, I expect all of you that you have studied this article. I want you to have a look on these two paragraphs. Just give a quick read. Because I need to teach you the treatment of cryptocurrency. This is the general discussion. This is the general introduction discussion. You can read it. You can read it for 2 or 3 minutes. Come on. You have 2 minutes to go through it. Now basically this cryptocurrency is basically digital tokens, or we say it intangible tokens. Intangible, if you buy a cryptocurrency, for example you buy Bitcoin, nothing physical thing, no physical note, no physical currency comes in your hand. It's a digital currency. That means you get a digital commitment. You get a digital commitment through an exchange, right? And you have the right to own it. You have the right to own it, and whenever you want to sell it, you can sell it. You can transfer it to third parties. You can transfer it to third parties. The last three lines, see these last three lines important. These last three lines are important. Last three lines are important, my dear students, right? Okay. Now the issue is how can we account for this cryptocurrency? How cryptocurrency can be accounted for? How cryptocurrency can be accounted for? Look at the screen. Look at the screen. I've just moved the screen. I have just moved the screen. First of all, some people says, first of all, the first point, some people thinks cryptocurrency is cash. Some people thinks cryptocurrency is cash. The answer is no. No, it's not cash. It's not cash. It's not cash according to IS 7 or IS 32. This is not cash. Why? See the screen. Wait, again, there is some problem with the screen. Wait a minute. Wait a minute. Wait a minute. Let me connect. Okay, now it's perfect. So what accounting standard might be used? What accounting standard might be used to account for cryptocurrency? This is a very interesting issue. First thing, some people think this cryptocurrency is cash. This cryptocurrency is cash, like dollars, like pounds, like rupees, like lira. This is a cash. No, no, no. This is not cash. This is not cash. Why? Many reasons. Number one, listen. The first reason, it is not backed by reserves. Normally our normal currencies are backed by reserves. Some currencies are gold backed, and some currencies are dollar backed. This is not a reserve backed currency. Number one. Number two, the reason they have written here, see, because they cannot be readily exchanged for any goods or services. See, if you have cash, look at here. If you have cash, you can buy anything. If you have dollars, you can buy anything worldwide. You can buy anything. They are exchangeable. By giving dollars, you can get pounds. By giving dollars, you can get rupees. By giving dollars, you can buy anything. But by giving Bitcoin, you cannot buy everything, because right now, till now, it's not acceptable worldwide. It's not acceptable worldwide. Even it is still banned in your Pakistan. It is banned in Pakistan, and maybe it may be banned in many other countries. So that's why it's not. See the line. They cannot readily be exchanged for any goods or services. That's why you cannot call it cash. You cannot call it cash. You cannot call it cash. That's why you cannot call it cash. Point number one. Point number two. I hope you are now almost a chartered accountant. SBR, you are on the SBR end. You are on the SBR end. Look at me. I hope you remember the definition of cash equivalent. You remember the definition of cash equivalent according to IS 7. So first of all, we denied it that it's not cash. First of all, we denied it. It's not cash at all. It's not cash at all. We did simply remove it. Now the second thing is, some people think it is cash equivalent. Some people think it is cash equivalent. Some people think it is cash equivalent. No, it's not cash equivalent. Why? What's the definition of cash equivalent? What's the definition of cash equivalent? First of all, let me read their lines and then I'll give you my definition. Cash equivalents are short term. Cash equivalents are short term, highly liquid investments that are readily convertible to known amounts of cash, which are subject to insignificant risk of changes in value. So there are two conditions. There are two conditions with cash equivalent. Number one, cash equivalent, look at here, cash equivalent are liquid investments which are readily convertible into known amount of cash. And readily convertible means it is written in the standard 3 months. All those investments which you can convert easily in 3 months, with the fixed amount you can get. And number two, that does not carry a significant risk. Now let's see these two conditions I have written with my pen. See, do you think cryptocurrency meets these two conditions? No. First condition, they are convertible into cash. Do you have any commitment with any other party that you will get cash? No commitment. Yes, if you find the buyer, yes, if you get the buyer, you can sell it, but there is no commitment. There is no contractual arrangement. With any other party that you will get the cash. So first condition not met, and second condition 100% not met. Why? No significant risk. But you have seen, you guys are not quits. You have seen there is a big fluctuation in the value of Bitcoin and cryptocurrencies. There you see a big fluctuation in the value of Bitcoin and these currencies. So yes, there is a significant risk. And what it is written, the risk should be insignificant. So again, it's not cash equivalent. So in these two paragraphs, you have seen it's not cash. Cryptocurrencies are not cash. And in the second line, we proved that it is not cash equivalent as well. It is not cash and not cash equivalent as well. Now, some people think it's financial instrument. Again, a big no. No, it's not a financial instrument. Wait. I hope you remember the definition of financial asset. Listen, financial asset is cash. It's not cash. Financial asset is right to receive cash. Receivable, it's not receivable because you don't have contract with the third party that you will get the cash. There is no surety. There is no contract. And the third major definition of financial instrument is equity instruments of other entity. Do you think over it, do you think that the cryptocurrency is the equity instrument of another entity? No, not at all. Equity instruments are not at all equity instruments of other entity. You don't get any ownership, voting rights of any other entity using cryptocurrency. So my dear student, it does not meet the definition of financial instrument of financial liabilities. That's why forget about it. Forget about the fair value through PNL or fair value through OCI thing. Fair value through PNL or fair value through OCI thing. Okay, right? Whatever I told you, it's written in this paragraph. Whatever I told you, it's written in this paragraph. And yes, this paragraph I have taken from accaglobal.com article. I've taken this from the accaglobal.com article. Okay, so now let's summarize it. Cryptocurrency is not cash. We proved it. Cryptocurrency is not cash equivalent. We discussed it. Number three, cryptocurrency is not a financial instrument as well. Cryptocurrency is not a financial instrument as well. So where should we fit this cryptocurrency? We can fit this in IS 38. We can fit this currency in IS 38 according to the latest research. Cryptocurrencies are accounted for using IAS 38 intangible assets. Now, let's read the definition of intangible asset. Let's read the definition of intangible asset. Read it. This standard defines intangible asset as identifiable. The first word is identifiable. The first word is identifiable. The second word is non-monetary asset without physical substance. See, identifiable, non-monetary, without physical substance. Three lines. Identifiable, please. Identifiable, non-monetary. Yes, yes. Those who want recording, I'll give them. Don't shoot. No issue. Listen. Number one, identifiable. Number two, non-monetary. And number three, without physical substance. Okay. Now, these three conditions, I'll prove it that it will that cryptocurrencies meets all three. Number three, identifiable means separate from the entity. Identifiable means separate from the entity. It can be sold, it can be rented, it can be transferred separately to another entity. Yes, it is possible. It can be sold. We all know that we can sell the rights of the Bitcoin and cryptocurrency. Yes. So yes, it is identifiable. Yes, it is identifiable. Okay. Number two, is this the cryptocurrency non-monetary? Is this the cryptocurrency non-monetary? Yes. But before go to the non-monetary, first let's read the definition of monetary. First, let's discuss the definition of monetary items. I hope you studied IS 21 from scratch. I hope you studied IS 21 from scratch, and I hope you have gone through the definition of monetary items. Look at me. Let me define you. Monetary items are cash. Monetary items are cash, number one, or right amount to be received, or amount to be received in fixed and determinable amount of money. Cash, number one, or number two, amount to be received in fixed and determinable amount of money that is receivable. If you think in depth, you will find these two conditions are not met by cryptocurrency. Cryptocurrency is not cash. I have already told you, cryptocurrency is not cash, and cryptocurrency is not a receivable. You don't have any contract with any third party that you will receive a fixed amount in future. So it's not a monetary item. It's a non-monetary item. It's a non-monetary items, right? So identifiable condition has met, non-monetary condition has met, and without physical substance, yes, there is no physical substance in it. You can't. It's all electronic. It's all electronic. It's all electronic. It's all, we can say, rights. It's all, we can say, rights. You don't get any physical note or physical paper. Nothing. Okay. So that's why we can conclude that IS 38 fits in with cryptocurrencies. So till now in this world, cryptocurrencies are accounted for. For a normal man, for a normal, not, I'm not talking about the dealer, I'm talking about the normal investor. For a normal investor or normal company, cryptocurrencies are accounted for under IS 38. Now the next step, I hope you remember. See, in IS 38, there are two models. In IS 38, there are two measurement models. The first is cost model and the second is revaluation model. The first is cost model and the second is revaluation model. So now look at me. When when we came to the conclusion, that cryptocurrencies are accounted for, under IS 38. So now you have two options, whether to go for cost model and whether to go for revaluation model. But one more thing of learning, and it's relevant for your SBR normal course. Listen, in IS 38 it is written very clearly. In IS 38 it is written very clearly, in very clear cut words, that for only on those intangible assets we can apply revaluation model whose active market exists. Revaluation model of IS 38 can only be applied for those intangible assets whose active market exists. That means on daily basis they are trading, daily basis that intangible asset is sold. So if I tell you, yes, for cryptocurrencies this revaluation model is, yes, for cryptocurrency revaluation model is there, revaluation model can be applied. Why? Go and check the data. You will see daily transaction of cryptocurrency. Many people are trading nowadays in cryptocurrencies, and you can have the active market. You can have the active market of cryptocurrency through exchange, you can see. So yes, cryptocurrencies applied using IS 38. And which model can be applied? Revaluation model you can apply. Yes, it's a choice, but you can apply revaluation model here. Now, just for your knowledge, just giving you 2-3 minutes on that. Sir, if we apply revaluation model, and for example we buy a cryptocurrency for $10,000. For example, we buy a cryptocurrency for $10,000, and its fair value went up to $12,000. Sir, what is the treatment? Of this upward revaluation? The treatment is OCI. The entry is debit intangible asset and credit OCI. Debit intangible asset and credit OCI. The same rules as we follow for IS 16, the same rules are for intangible asset revaluation. Whatever rules you have studied for IAS 16, the same rules you can follow for IS 38 revaluation. Okay. Now one more question. For revaluation, if you are using revaluation model, then you need to calculate the fair value. You need to calculate the fair value. Listen, and for fair value calculation you should knock the door of IFRS 13. Sorry, for fair value calculation you should knock the door of IFRS 13. Just a quick recap. Hope you remember IFRS 13, 3 levels of input: level 1, level 2, level 3. Hope you remember the 3 levels of input: level 1, level 2, and level 3. Now I invite all of you in the comment box. Kindly tell me which which level we should use for cryptocurrencies. Come on, tell me. Excellent. Level 1. Excellent. Because there is an active market of identified good, similar exact good. There is an active market. There is an active quoted market. Of that identifiable good is available. That's why that's why level 1 can be used. Okay. So now you have two examples of level 1. The first example of level 1 normally we teacher gives is stock exchange. The quoted company shares, we give this example. And now you have one more example is cryptocurrency. Now for level 1 you have one more example, that is cryptocurrency, right? So if we summarize it, how can we summarize it? Listen, cryptocurrency is not a cash. I proved it. It's not cash equivalent. It's not financial instrument. No, no. Even it's not investment property. It's not investment property. It's not land and building. It's not land and building. Okay. So that's why finally we came to IS 38, and the definition of intangible asset meets, this cryptocurrency meets the definition of intangible asset, the three words: identifiable, yes; non-monetary, yes; and number three was no physical substance, without physical substance. So all these conditions fits in with cryptocurrency. That's why IS 38 is the solution. IS 38 is the solution, right? Okay. And then with IS 38, we have two measurement models, the cost model and the revaluation model. Cost model and the revaluation model. Okay. Right. And normally in IS 38, revaluation model is only allowed. Revaluation model is only allowed if active market exists for that revaluation model. And yes, for cryptocurrency, active market exists, right? Now, I would recommend you guys to read the complete article of cryptocurrency, because this article was little big. I just gave you the summary. I just gave you the major heart of that article. Okay. Now, very interesting, but this current issue is not available at accaglobal.com. This current issue is not available at accaglobal.com. It's a research from other websites. It's a research from other websites. So you just have to get the concept of it. That's it. No more detailed learning, only concept of it. See, I hope you remember, or you all remember the name of IS 8. First of all, let's recall the name of IS 8. The name of IS 8 is changes in accounting policies, changes in accounting estimate, and prior period errors. The name of IS 8 is changes in accounting policies, changes in accounting estimates, and prior period errors. Okay. Right now, we are not discussing the second name, only the first name, the change in accounting policy. I hope you remember. Listen, I hope you remember, when can a company change the accounting policy? When can the company accountant can change the accountant policy? When one of these conditions is satisfied. If allowed by accounting standard, if accounting standard says to change, then you can change it. And if that policy change increases the relevance, reliability of financial statement. If that accounting policy change increases the relevance and reliability of financial statement, then you can change the accounting policy, right? This is the basic standard existing knowledge. I'm just telling you, you all know this. Now, let us say you are going to change accounting policy. You are going to change the accounting policy. You are going to change the accounting policy because of one of these reasons. It is allowed. Now, how will you apply this change? How will you apply this change of accounting policy? The change of accounting policy is applied retrospectively. The accounting policy change shall be applied retrospectively. What does it mean? Retrospective means you should go in past. And from the date we applied the existing policy, we should change this policy. We should apply this policy from the past date. Means you should go in many years. Now, but it is also written, unless impracticable to do so. This is the real current issue. This word impracticable is the real issue which we are going to discuss now. Listen, for example, original policy we were using for last 5 years. For example, okay. And now there is a change in policy. So technically we should go last 5 years and change it. technically we should go last 5 years and change it, but standard says if you cannot go to 5 years or you have only 3 years data, you cannot in the practical world you have limitations, and you cannot go 5 years back and you have only 3 years data, or you can only go 3 years back. Okay, go 3 years back and do 3 years past 3 years restatement, do past 3 years restatement. This is called impracticability. Then that go to the point in past where it is practicable, or I say easy word, possible to do so, right? This is the existing standard. This is the existing standard that you have to go in past. You have to go in past, but till when? The day it is practicable to do so. That's it. Go till the point it is practicable or it is possible to do so. So out of 5 years, if it is possible only 3 years, go 3 years, right? Okay, this is. But one more thing. I'm not teaching right now US GAAP. US GAAP is separate thing. We are discussing IFRS. You know, listen, if you invest in a company, so you will get the financial statement, and with that financial statement you get the comparative data. With that financial statement you get the comparative data. Which comparative data? See, for example, this is December 2020. If you are getting the financial statement of December 2020, if you are getting the financial statement of December 2020, you will get the SOFP of December 2020 as well as the SOFP of December 2019 and December 2018. So you get 3 SOFPs and 2 SOCIs. You get 3 SOFPs and 2 SOCIs. This year SOCI and last year SOCI, and SOFP you receive 3 years. This is the existing format of IFRS. This is the existing format of IFRS that you will receive. And for change in accounting policy, the new policies applied here, and here, right? No doubt you applied 10 years back. No doubt you applied changes 10 years back. You have to take the cumulative. You have to take the cumulative impact of all previous transaction in this SOFP, in the last SOFP. That's the requirement of existing IS 8. Okay, I repeat one last time. Just think, change in accounting policy is applied retrospectively. Yes, retrospectively means go in the past and change, go in the past and restate the financial statement. For how many years? Till when you can go, the maximum possible time. Okay, but to the shareholder you will report this current year SOFP, last year SOFP, and one more SOFP. 3 SOFPs and 2 SOCIs. 3 SOFPs and 2 SOCIs, right? This is for the shareholder reporting. Now, what is going to be changed? What is the new proposal? What is the new proposal by board? This is the proposal. See, this is the proposal. To facilitate voluntary changes in accounting policy that result from an agenda decision, the board proposes amending IS 8, lower the impracticability threshold for retrospective application of such changes. Means, in short, board is going to do relaxation. Board is going to do relaxation in this IS. That means now you don't need to go 10 years or 5 years back. They will set a threshold. They will set a time period that you should go only 2 years or 3 years back. They have not right now disclosed the threshold, but they are planning to make a threshold, to make this IS easy, to make the application of this IS easy. Now one more question. Sir, why now in 2020 the board is planning to give relaxation on this standard? Look at the reason. Because if you see, and you are seeing, you can see the all You can see in last 5 years or 10 years, there are a lot of new standards. There are a lot of new accounting standards. You have seen a lot of new accounting standards. And because of lot of new accounting standard, lot of new treatments, because lot of new accounting standards, there are new treatments. So new treatments just take over the existing treatments. So normally every year, or every 2 year, accountant has to apply IS 8 for changes in accounting policy. Accountant has to apply IS 8 for changes in accounting policy. So if they do retrospective application for 8 years or 10 years in routine, so this will be a big burden on accountants. So in order to give relaxation to accountant, they are going to change this standard. They are going to set a threshold. They are going to set impracticability threshold. Okay. Now finally, the proposed threshold would include consideration of the expected benefits to users of the financial statement applying the new accounting policy retrospectively, and the cost to the entity of determining the effects of retrospective application. Cost versus benefit application. Now wait, please, few minutes energy I need. What's your current IS 8 says? Current IS 8 does not talk about cost benefit. Current IS 8 is rigid. Current IS 8 says go retrospective. Go retrospectively, straight away go retrospective. But the new IS 8, the revised IS 8 will going to say like this, that first check the benefits and cost of retrospective application. First check the benefits and cost of the retrospective application, and if, listen to me, if benefits are higher than cost, then go for retrospective, otherwise don't, no need. If benefits are higher than cost, then go for retrospective, otherwise no need. That is going to be the accounting of future, not current accounting. This is again on discussion. This is again on discussion, right? Now student may ask, as a student you may ask, sir, what are the benefits? Sir, what are the benefits? As a student you may ask, sir, what are the benefits of retrospective accounting, retrospective application? See, these are some of the benefits I'm going to discuss. Wait, you can have a read. You can read it. The first benefit of retrospective application is obviously comparability. In short, let's save the time. Comparability. That means this year financial statement will be comparable with last year financial statement. It's very easy thing. You should grasp it. It's very easy. Number two, magnitude of the change. Yes. Wait. You all know that retrospective application means you adjust opening retained earning. And when you adjust opening retained earning, you see you report an absolute number to shareholder, that because of this policy change, your retained earning went up or down by this amount, this $1 million. So that shareholder can realize, so that shareholder can understand that because of this accounting treatment change, we had this much loss or we had this much profit. You are getting? Now, pervasiveness of the change. Now wait, this is very technical. Pervasiveness means what is the effect of this transaction on the overall financial statement. Overall financial statement. Wait, Azan, wait. let's take a 10 minutes break and then we'll resume. Okay, we are taking 10 minutes break, 10 minutes sharp and dot, 10 minutes. Okay, welcome back. Now we were discussing the benefits of retrospective application. The first benefit is obviously because of retrospective application, comparison is like with like. This year financial statement is comparable with last year. Number two, because of retrospective application, shareholders can see the magnitude, it means actual absolute impact of that change in accounting policy in absolute numbers. Okay, because we are just opening retained earnings so that they can see. Number three, the pervasiveness of the change. Pervasiveness of the change means this change ultimately affect the complete financial statement. How? For example, if we talk about revenue recognition, IFRS 15, so you know the entry of credit sales. See this, the entry of credit sales is debit receivables, credit sales, credit sales. So now just think over it. If you go in past and you change this, the receivables and sales of past, if you go in past and you change the numbers of receivables and sales, so just think, the sales will hit income statement, and through income statement it will hit profit, and through profit it will hit retained earning, and retained earning is a part of equity. And when you change the equity, many of the ratios will be changed, like gearing, like return on capital employed, many ratios, return on equity, it will affect many ratios. Similarly, you go in past and you change the receivable number. So receivable is it comes under the heading of asset side. Receivable comes under the asset side. So your current asset and your current ratios will be affected. So that means the change will affect the overall financial statement. Giving you one more example of IFRS 16. If you remember previous IS 17, there were lot of room for operating lease. In previous IS 17, there was a big room for operating lease for lessee books. But now in IFRS 16, almost operating leases are sidelined. For lessee books. So now, if a company has been using IS 17 for many years, and now that company has been shifted to IFRS 16, so there is a possibility that they have to go in past and they have to shift operating lease accounting to finance lease accounting, operating lease to finance lease. So obviously, when you shift yourself from operating lease to finance lease, think over it, operating lease to finance lease. So you should go in past, you need to go in past. You have to book not only ROU, right of use, lease obligation, depreciation, interest expense. So it will affect many of your ratios. It will affect your interest cover. It may affect your cost of sales. It may affect your asset side, your liability side. So many ratios will be affected. So the shareholder, through the retrospective application, shareholder can see the big picture, the pervasiveness of the change on the complete financial statement of the entity. So these are the benefits. So what are the cost of retrospective application? Obviously, normally, personally, many of my students, they are working in many entities, so they personally give the feedback, sir, we hate retrospective accounting, it's very tough and very time consuming. Okay, so additional efforts and cost in accumulating data, or obviously sometimes a normal accountant can't do this, so you need to hire an audit firm for this, you need to hire external accountant or a chartered accountant, highly paid, so it's a cost. Will the change in accounting policy materially results already disclosed in the last periods? Now, this is a question, and just think over it. Will that retrospective change will actually benefit the shareholder, or will it confuse the shareholders? Because it is difficult to understand the retrospective data. It is difficult to understand the retrospective last year retrospective workings. So this is also a question raised by many people, that is this relevant for shareholder or not? Okay, so this is the new, this is the new current issue. Have a look, you have 1 minute. And in the end, I have written why this relaxation. I told you why this, because new IFRS coming out and with new treatments. So if we go retrospective every time, it will be costly and time wasting for accountant. This is one of the reason of this change. There is a question how to adjust the change. Not only we change the opening retained earning, but we also adjust the last year financial statement for comparison purpose. Now, one more area which is called management commentary. Also, I agree. It has already been tested in SBR. It has already been tested in SBR, but in my eyes, you must have a little touch of this. Okay, and I know you, many of you have already done this, but still just an overview of this topic. Now see, I have written very easy language. Normally accountants just follow IFRS just like performing a legal duty. Yes, you know, accountant has to make the financial statement and they do it as a legal duty, because if they don't apply IFRS, auditor will qualify their report. And they will be in trouble. So they just follow IFRS. And normally it is also said that IFRS, it's all number crunching. They are involved in number crunching, but look at the real environment you see around us. There are a lot of other factors which affect the business. Shareholder is interested in business, in the performance of business and overall future of the business. So there are many other factors which are going on in this practical world which affects your business. For example, if I take the example of United States, so recently last year you saw there was a fight between US and China, and this affected many businesses because of the imposition of duties by US government. Chinese products were very expensive, and now if you see, they have almost started banning Chinese products. So now there is one more thing they have started, and that new thing is production inside US. Now they have started production inside US. So new companies are going there, and the new partnerships are going there for the production. So this is a change. So at least in the financial statement, we must have such area that we communicate with our shareholder with these changes, these future changes, and these are also business risks, and shareholder must be aware of this. You're not getting. So only number crunching, only balance sheet, income statement is not enough, because income statement, balance sheet is related to the past data. But in reality, they are responsible to explain performance of business. Now, what directors and accountants do, they voluntarily disclose the performance of business and business units in chairman reviews or director reports. I hope you have seen a financial statement in your whole life once. There is a section of chairman's review or director's report or chairman's report in which chairmen communicate with the shareholders that segment wise we are improving, or this product is going, we are going to launch a new product in future. In this way we'll cut down our competitors, and all the strategies they discussed, right? But the problem is there is no regulation in this area. Now the chairman's review, that's a voluntary area. That area is we write that area with our own wish, and there is no regulation. Normally there is no regulation on that director's report and chairman's review. So when there is no regulation, so that's why they only communicate. Sometimes they only communicate, see this, sometimes they only communicate the good news and they hide or understate the, can you see, they hide or understate the bad news. They hide or understate the bad news. Okay, so that's why International Accounting Standard Board has started working on this area, because this area is equally important. Only numbers are not important, but also the other news of the business model, the competition, the risk of the business associated with the business, these are also important. So that's why, now look at, that's why IASB issued a non-binding guidance. First of all, please, the guidance which they are planning to issue is non-binding guidance. It's not mandatory. It's not like IFRS. It's a voluntary guidance document and has guided regulators. Now, what do you mean by regulators? Just like if in Pakistan we have SECP, Stock Exchange Commission of Pakistan, right? They regulate the companies. Similarly, we have a body like ICAEW. Similarly, in UK, ICAEW body, different bodies, right? Okay, so International Accounting Standard Board issued these guidelines and has guided the regulators, those who regulate the country, to copy it with or without modification. Whatever guidelines I'm going to tell you, International Accounting Standard Board has said that you can directly copy paste it. If you want to copy it, you can copy it. And if you want to modify it, do little modification and then apply it, because there are many things which local law can impose. There are many things which local law can impose. Why? Because local law knows the problems of the country very well. I think Pakistani people know the problems of Pakistan very well as compared to the International Accounting Standard Board. That's why there are many things which are regulated by local standards. If I give you the example of Pakistan, in Pakistan, normally IFRS 9 is not applied by insurance companies or insurance company. In insurance companies, there are different rules. Even there are some standards which are not applied in banking sector. Government has given different rules for that. Okay, so, and you know, whenever there is a clash between local law and IFRS, whenever there is a clash between local law and IFRS, local law prevails. Local law prevails. I hope you remember this. Okay, so that's why IASB has issued non-binding guidance. Non-binding, it's not mandatory, and has guided regulators that you can copy these points. What are these points? See, IFRS practice statement requires management commentary section to include information that is essential to understanding of these all things. First of all, define the nature of business, whether you are a wholesaler, whether you are retailer, whether you are middleman, what's the nature of your business. Okay, then management's objectives and strategies. Write down something about your strategies, your future prospects, the entity's significant resources, risk, and relationships. I just gave you the example of China, United States and China. Then the results of operations and prospects, the critical performance KPIs. What are the major KPIs? Okay, indicators. And especially with this COVID thing, this section is very, very important, because now many companies has changed their business model. Even I've made many videos on it. I've spoken this on many platforms. We all know this. Now there are many, normally the employees are working from home. Even in the New York, people has left the buildings. Even they are not facing the fixed cost. Some companies has decided to permanently work from home. They have shifted many employees to work from home or work from anywhere. The new competition is work from anywhere. And work from anywhere means now you can select employees from the whole world. You're not getting. I give you one example. You know, there is a big difference of fees. There is a big difference of fees. ACCA tuition fees. I give you practical example. There is a big difference of ACCA tuition fees in UK and Pakistan. In UAE, in Pakistan. In UAE, if you study from UAE, I think the tuition fees for SBR is around 4 to 5,000 AED. Tuition fees for one SBR paper is 4 to 5,000 AED, which is more than $1,000, which is more than 1,000 US dollars. Can you think? So now, but the fees in Pakistan is very low. So now you see from these countries, students are studying right now. You guys are studying online. Right now in this class, I can see many students from UK, many students from Canada there, because comparatively we are cheaper. Comparatively, Pakistani and these sides, the labor is cheap. So see, just think, this is a competition for them. This is the competition for those institutes, and this is the age of technology. The news is everywhere. So now they need to revise their business models. That's a challenge for them. So in the management commentary, they should include this point that we are facing this competition. So they should revise their fee structure, or they should revise their strategy. Okay. One student has comment a lot. One guy from Canada, I know the name of this guy. He has commented. See. Yes. So don't forget that this management commentary is a voluntary section, my dear student. This management commentary is a voluntary section. It's not mandatory. Okay. And whatever IFRS IS board has issued, again, it's non-binding guidance. Read this word. And IFRS board has suggested the regulators to copy it as it is, or wait, or modify it and then apply it, because the local law can impose things very easily, because they know about their own country well. Regulators know about their country's issues very well. Okay. So just these points you can read 2 to 3 times is enough. 2 to 3 times read these points, it's enough. Okay. Some students are asking about the COVID current issue. Some students are asking about the COVID current issue. Let me openly tell them. This class is not related to COVID, but yes, I have one class available with me for COVID, but it's in Hindi or Urdu language. If somebody wants that class, they can WhatsApp me. I have written my number here. If somebody wants that COVID class, COVID changes, I can provide, no issue. Okay. Right. Now the last current issue is linked to financial instrument. I hope you remember. I hope you remember the definition of debt and equity, the definition of financial liability and equity. A normal definition of debt, financial liability is contractual obligation to deliver cash or contractual obligation to deliver a financial asset. Easy definition is contractual obligation to deliver cash is a financial liability, and contractual obligation to deliver a financial asset is also a financial liability. Basic definition. And what is equity? What is the definition of equity? Residual interest in assets after deducting all liabilities. Residual interest in assets. Hope you remember this equation. Hope you remember this equation. C is equal to A minus L. C is equal to A minus L. C is equal to A minus L. This C is equity. This C is equity. Okay. So the definition of debt is contractual obligation to deliver cash, and the definition of equity is residual interest. Now, the apparently the definition looks very easy, but when we solve the questions, hope you have solved some questions, like I give you example. There was a question Athens, there was an old question Athens, there was one more question Bentel and Lentil. These questions were old past papers, and few more questions like that, in which there is a subsidiary company and subsidiary company has issued class A and class B shares. These type of questions. Subsidiary company has issued class A and class B shares. Now identify which one is the liability and which one is the equity, which shares are liability and which shares are equity. So practically it becomes very difficult. To identify, to draw a to draw a line between liability and equity. One guy has commented this they makes us mental. Bental, lentil and mental. Yes. So practically it's very difficult to identify between liability and equity. That's why International Accounting Standard Board is thinking, there is a discussion paper, International Accounting Standard Board is thinking to make it easy, to make it clear cut, to identify the difference between liability and equity. Now read. When it comes to practical questions, this area is little complex. I'm sure you have seen questions like Athens, etc. In such question, it is difficult to identify whether the instrument is debt or equity. There is lot of yes. There is lot of principle-based instruction in IFRS. Now I have a question. Right time, right wordings. Do you guys know the difference between principle based and rule based? Tell me, comment please. Do you guys know the difference between principle based and rule based approach? Principle based and rule based. Come on, comment. Wait, let me tell you, giving you some light. Listen. What is principle based? I have one servant in my home. Listen, today some special guests are coming. I have ordered my guests to prepare some good food, good quality food. This is the word. This is my wording. What I said, prepare good quality food. That's it. This is principle based. I just told him principle. But if I say him, dear, go and buy chicken from Nando's, or go and buy peri peri chicken, or go and buy McDonald's burger, 3 McDonald's burger, 3 smoked chicken burger from that, this and that. If I define the exact quantities, the exact name of the restaurant, now this is rule based. One more example. If I say you to drive slowly, this is principle. If I say you that don't drive over 50, you cannot increase the speed over 50, this is a rule. Okay, now open your eyes and listen this issue. And yes, this issue is relevant for you all are accountants. IFRS is much more principle based, but United States US gaps are rule based. This is one of the major reasons why, right, till 2020 United States has not accepted IFRS, because US economy is very strict economy. There are a lot of litigation issues. If you do a little mistake in US, people sue you. So to solve the problem, to solve any problem in US, the rules should be fixed. To solve any issue by the court, the rules should be fixed. Otherwise, there will be a lot of clashes. So that's why United States standards are rule based and IFRS is principle based. There is a lot of flexibility in IFRS. There is a lot of judgment in IFRS. Even you can use your own point of view in IFRS. And let me tell you, connected to this topic, in this topic, whenever you answer the question, there are many indicators. There are many indicators. You read those indicators and then you say, yes, the major point goes towards the equity, or the major points go towards the debt. And then you write the conclusion. This is the way we write. You're not getting. Whenever you get the question in your SBR paper, you starting selected the points, you started collecting the evidence. And if the major evidence goes with liability, you go for the, you write in the conclusion, you write the liability. And if the major points goes towards the equity, you go for equity, right? So IFRS is much more principle based, whereas US GAAP is rule based. Okay, so that's why I use the word. There is a lot of principle based instruction in IFRS. They have given you indicators through which you decide whether it's debt or equity, right? This is the existing structure. Now, discussion paper. First of all, as this area is little bit vague, I'm just taking last 15 minutes, please concentrate. As this area is little bit vague, so if a person intentionally, if an accountant intentionally classify a debt into equity, if an accountant intentionally classify the debt into equity, what will be the consequences? What will be the consequences of wrong classification? Come on, see it. Number A, both are presented in different sections. It's like change of class of account. I hope in the basic level, when you were kids, when you were accounting kids, infants, you studied error of principle. Liability and equity are two separate class of accounts. Liability and equity are two separate. Even in the balance sheet, they are presented separately. In the balance sheet, they are presented. In the SOFP, they are presented separately. So that means you are totally changing the class of account. This is the principal error you are doing. And one more thing, one student has said, gearing will be changed. Gearing will be changed. The financial risk of the organization will be reported wrong. Okay. Then now further measurement of liabilities are different and equity are different. Wait, let me recall you one thing, and that's helpful for your consolidation. I hope, listen, I hope you remember contingent consideration. There is a topic, contingent consideration in consolidation. Contingent consideration in consolidation, and you make the entry like this. Wait, the entry for contingent consideration is investment debit, and contingent consideration credit. I hope I'm not teaching to infants. My dear boys and girls, each and every teacher teaches this topic of consolidation: debit, investment, credit, contingent consideration. Now, this credit side, look at here, this credit side may be a liability, and sometimes it becomes equity. I hope you remember this. This credit side, investment debit and contingent consideration credit, this credit side sometimes becomes liability and sometimes becomes equity. Now, if this credit side has become equity, so you know what to do with equity. I often say this to my student, you just put equity in freezer. You just put equity in freezer and you sleep. No more future changes. In future, you don't need to bring equity to fair value. You don't need to do any mark to market accounting. You don't need to do any mark to market accounting for equity. In future, you don't change it. Even you have seen this type of question in your consolidation. But if this credit side is treated as a liability, then it is the requirement that at each year end you need to bring it to fair value. You need to bring it to fair value with changes taken to retained earning and P&L and all. So see, just think, if you do wrong classification, if you do wrong classification, your further measurement will all be changed. See, equity or never recorded at fair value in order to save yourself from mark to market accounting. Now this is the fraud which people do. In order to save yourself from mark to market, you may classify debt as equity, because now you don't need to apply IFRS 13 as well. See, this is the game. If 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 there if there is an accountant, and that accountant does not want more work pressure, so what they will do, they will classify liability as equity, because once they classify it as equity, now there is no more future mark to mark accounting. In future you don't need to calculate fair value, no more IFRS 13, nothing. Enjoy your life, enjoy your life. Number C, you know, we all know, we are accountants now, and we all have studied financial instrument. Normally standard board is very strict for liabilities. Normally standard board is very strict for liabilities. So once you classify anything as a liability, then there is a detailed disclosure requirement. So disclosure requirements are very detailed for liability. Once again, so if you classify liability into equity, disclosure requirement will be changed. You will save yourself. You will save yourself from. You will save yourself from disclosure requirement. Okay. And number D, your financial risk will be reduced. I have already taught in point number A, your gearing will be changed and your financial risk will be changed. See, so these points are not only important for current issue, but for also your SBR knowledge. These 4 points are very important for your normal SBR knowledge. You need to have a lot of data in your mind just to fix things. Now, what the board has proposed, what the board has preferred approach. I repeat, this has not yet been implemented. This is just a discussion paper. This is just a discussion paper. Don't think this has been implemented. No. Now, the board has proposed a preferred approach to classify claim as liability. See, when number one, timing feature. They will say, now in future they are planning to check these two things. If you find these two things in any financial instrument, if you find these two things in any financial instrument, then it is liability. And if you miss any of the thing, then it is equity. Okay. Now, number one, timing feature. To transfer cash or other financial asset at a specified time in future. That means there there should there should be a time limit. There should be a exact time in which you are liable to pay cash, in which you are liable to pay cash, or you are liable to transfer a financial asset. Then it will be a financial liability. And one more thing, it is written, other than in liquidation. If it is written that at the time of liquidation you will pay, then it is not a liability. If it is written that at the time of liquidation you are paying, then it's not a financial liability, because at the time of liquidation you also pay to equity holders. At the time of liquidation you also return money to equity holders. So in this way you will mix it with equity. So what standard is planning, what IS board is planning, the timing feature is, they are saying that there should be a fixed time when you are going to pay, when you are going to transfer cash or financial asset. This is the first feature they are going to launch. And the second feature is amount feature. An amount payable is independent of any entity's resources. Means no, what does it mean? If I'm saying that if I get profit, I will pay you, otherwise I won't pay you. If I get profit, if I'll be profitable, then I'll pay you, otherwise I won't pay you. So in future, this is not going to be liability. In future, this is not going to be liability, right? Okay. So an amount payable is independent of any entity's resources. That means you are not going to link it with other resources, that if we get this, then we'll pay you, then this is not a liability. Then this is not a liability. Okay. So just read these 2-3 lines 2 or 3 times. That's it. And now I'm going to tell you my final words. Listen, this is a very big paper. We know it's a professional paper, and it's not like F7 that you hope you remember. Many of you join ACCA through normal route, and I know some of the students join ACCA after getting exemption till skills module. So those who have given F7, they know in F7 final accounts adjustments are repeated, consolidation adjustments are repeated normally. Even ratio analysis questions, similar question comes after 2-3 years. But normally in these professional exams like SBR, a new paper comes. So it's like an interview. It's like you have to solve the whole paper. You have to give a suggested solution. I must say, you have to give a suggested solution. And as the paper is difficult, and as the paper is technical and connected to practical life, that's why they have given headroom. I discussed that issue, that for 10 marks question, the marker will start checking with 14 marks or 13 marks. For 10 marks question, marker will start marking it as if it is a 14 marks question. So this is the relaxation. This is a relaxation they are giving you. This is the relaxation they are giving you. And this is a very big relaxation. Okay. So stay calm, be confident, try to attempt 100 marks. Okay, so that you enjoy this headroom issue, so that you enjoy this headroom issue, so that you enjoy this headroom issue in all 4 questions. In all 4 questions, 1 2 3 4. If you miss question number 4, or if you miss question number 3, you will miss this enjoyment of headroom as well. For that whole question and complete 0 you will be marked. Okay, so better attempt the complete paper, and better solve one mock exam. Just take one past paper. No need to get mock from anywhere. Just take the print out of any past paper September 2019, and you start solving it in your limited time period. At least solve one paper, so that it will be the second time in the exam that you are solving it. Don't take this risk that you are doing first time. Solve at least one mock paper. Still you have time. Honestly, I'm saying this will benefit you. Solve at least one mock paper with you before exam. Okay, right? So best of luck all of you, and I will post this class on the YouTube as well, so that other students can see, even you guys can see it. And that's my WhatsApp number I've written here. If you guys want the slides of these questions, I'll forward you. Okay, so take care, and best of luck for your exams.